Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode, as always. And how could you not be when we have such a big episode planned? We're going to talk about the latest news in superannuation. Are Australian super funds growing up and leaving the nest? We're going to be joined by Luke Laretive from Seneca Financial Solutions for another Pimp My Portfolio, where he reviews the real portfolio of an Equity Mates community member. And finally, we're going to talk about fees.
Oh, wow. What an exciting episode. Superannuation and fees.
But
Yeehaw.
Trust us, you'll like this segment.
Now, if you've just joined us, you might find that there are some different episodes in the feed over the last couple of weeks, and that's because we've been introducing our latest podcast, Basis Points, and that continues tomorrow with another episode from our 6-episode launch. Basis Points is a podcast that we designed for financial advisors, but is definitely applicable and accessible to all of you guys listening. There is some awesome content in there, and tomorrow we are tackling the big topic around how can we find returns outside of the Magnificent Seven with Alexander White. Make sure you stay tuned for that. All 6 episodes, though, are available on the Basis Points feed and the Basis Points YouTube, and we'd love it if you could sign up to the email as well.
And if you are an advisor, the most exciting thing is all 6 launch episodes are accredited by the FAAA for CPD points. So head to the YouTube description or show notes to find out how. But Bryce, with that said, let's get to the news of the day.
News and markets.
So the big news that's coming out at the moment, Ren, around superannuation funds is that they're getting so big that they are outgrowing the Aussie market and can no longer find opportunities here.
Yeah,
It's
so
wild.
well, I mean, there's really we've got the big 2 emerging in super, which is Australian Super and Australian Retirement Trust.
Yeah.
And then there are some other massive ones, but the problem is they're getting too big for the Aussie market.
Yeah.
And we shouldn't be surprised. The Australian superannuation sector is now about $4 trillion. Australia's GDP is $3 trillion. Australia's stock market is what? Less than that still?
2.7.
Yeah. So we shouldn't be surprised that at some point they grew up and they left the nest.
Yeah.
But the latest stats from Australian super is that 7 of every $10 that Australians are putting towards their super are now being invested outside of Australia.
Yeah, so they're so large that the Australian stock market and economy can't really absorb the huge sums of money. And to put that into sort of perspective, Australian super will soon be managing about $100 billion here locally. And they think that is such a large, it is such a large sum that it becomes very difficult to achieve outperformance or essentially beat the index because you have such large sums of money. You can't just be throwing them in the small end of town because the liquidity is not there.
Yeah, and that's why, all these active fund managers were short the big banks and everyone was writing on, AFR and Livewire about the banks have to fall and they just wouldn't. Well, CBA still hasn't because super money has to go somewhere and the large caps are the most liquid. But now I think then they're more and more are just going overseas.
Yeah. So I guess the question then becomes, well, what does this mean? Should we be concerned about this? Is it going to have an impact on us as retail investors? Is it going to have an impact on our own superannuation funds if we are with these big, large industry super funds? It's an interesting dynamic. I think on one hand, there's an argument that if they do start shifting even more outside and that $7 out of every 10 becomes $9 out of 10, will that impact demand here on the ASX? Will we start seeing reduced demand? That's a question.
No. Because it's sure, 9 of every 10 new dollars will flow overseas. Eventually, it'll probably be 10 out of every 10 new dollars. But the stock of super money that's already invested in Australia
will remain.
Yeah. And so you won't get incremental demand, but like if they're capped out, like I don't think this really matters.
Yeah.
You know, you think about the largest sovereign wealth funds in the world, and essentially super is if you think of super as a collective, it is Australia's sovereign wealth fund. It's just in individually allocated accounts.
Yeah.
They all outgrow their country. The Norwegian sovereign wealth fund, all the Arab states sovereign wealth funds, they all are known for investing overseas because they have to.
Yeah. I reckon it's a good thing.
Even the Future Fund invests.
Get out of Australia.
Yeah. And so it's like the argument against this is like this is money that could be used to stimulate the Australian economy and invest back in Australia. And the current government had policies around giving super a purpose outside of just securing Australia's retirement and like trying to invest in like new home construction and stuff like that, which is all a bit like, it's not really the point. It's good. It's good that Australians have more and more money in retirement. It is just a fact of life that these super funds have more and more money. They need to invest it somewhere. Australia's not big enough, so they have to go overseas. It's neither good nor bad. It just is.
Is what it is.
Yeah.
Here's a wild stat that we came across while doing this. So 33% of the ASX is not controlled, but owned by super funds.
Wow.
Yeah.
Okay. That is wild. Yeah. For me, the interesting thing is if I was a super fund, so you know how... Why is that funny?
I don't know. If you were a super fund.
Yeah. If I was a super fund and a boy can dream. So there's now these super performance tests where you and they benchmark them to the Aussie index, and they say that they have to be delivering returns basically in line with the Australian share market. The question will be, as these funds get bigger and more diversified outside of Australia, they will, in theory, be less correlated to the Aussie market. And there will be periods where, if a super fund is majority global stocks, minority Australian stocks, and the Australian market has a really good year relative to Europe and the US, then it will be this interesting phenomenon where it's like, well, they've underperformed the Aussie market, but like structurally, it's not really their fault.
Yeah. But is it performance against Aussie market?
So I had a look at this in the lead up to this episode, and it's a bit more, I guess, nebulous than that. So the APRA benchmarks include the ASX 300 total return index, but also include simple reference portfolios and strategic asset allocation models.
Right.
But the ASX 300 is part of the benchmarking.
Okay.
Yeah.
Well, as you said earlier, Ren, it's neither good nor bad. It is what it is, but something we'll be watching over time, that is for sure. So if you want to keep up with all of the headlines that are catching our attention, then make sure you subscribe to our daily newsletter. There'll be a link in the show notes. Every day, 6 a.m, straight to your inbox, we send you a summary of the most important headlines from around the world. And if that's not enough, we also have it in a podcast. It's called Headlines by Equity Mates. So tune into that. You'll find it where you're listening to this now.
This is Pimp My Portfolio. Pimp My Portfolio.
That's right. We have a community member on the line, an expert in the room, and we're going to get that expert to review the portfolio of our community member. So firstly, Luke Laretive. Luke, welcome.
Bryce, Ren, how are you?
Very well.
Good.
And on the phone, we have Tom.
Hey guys, great to be here.
Now, Ren, as always, you're going to take us through Tom's portfolio and then over to the expert.
Yeah, okay. So Tom's got 9 positions, excluding a little bit of cash and a little bit of crypto. But in order of largest to smallest in the portfolio, we start with some Aussie stocks. We've got Pro Medicus, Pinnacle, Commonwealth Bank, and then we've got the ASX 200 ETF. Then we go overseas. We've got Microsoft, Nvidia, back home, Wesfarmers, ResMed, and closing it out with the NASDAQ 100 ETF. So a couple of ETFs, a couple of international stocks, a couple of Aussie stocks. Tom, we always like to start with Luke giving the portfolio a nickname. So I say this with trepidation given some of Luke's previous nicknames.
It's been a while since I've been on a nickname game.
But Luke, where do you want to start?
Tom's portfolio is called the dopamine decision maker.
Okay.
And the reason why is he only holds on to his winners and he's got no valuation discipline. So just wants the dopamine kick all the time from the green numbers in his portfolio, making him feel good. Just gets rid of the red ones. So
I think that's Luke's way of saying you've made some good
you've
stock
picked some good
picks.
stocks.
But, we don't give compliments here.
You certainly don't.
I'm not in the business of making people feel good.
So Tom, how do you respond to that?
I think there's definitely a bit of truth to it, but I also think the other way that it works is the others that I've sold out of broke the investing thesis. So I'd say these ones
He's
still,
got a brain.
still carry
He's
it.
got a brain.
Good response.
If I'm holding on for the long term, I guess part of the reason I'm here today, thinking about valuations is part of my thinking.
Well, why don't you talk us a bit through your portfolio, how it kind of came to be this position?
So starting at the beginning, started out as a lot of people I think seem to do by investing in blue chip Aussie company, ASX listed, which for me was Commonwealth Bank, Wesfarmers, and the ASX 200. And then as I learned more about investing, started to buy up some specific shares. So medtech companies I really like, which was Pro Medicus and ResMed. I also work in the investment management field, so had a look at Pinnacle and picked up some of them. And then last year when bank vals run pretty hard, sold out some of those and reinvested into some US tech.
Nice.
Good trade. Tom, so do you believe the markets are efficient or inefficient? Do you think that, you can go pick stocks and you can outperform the markets, or do you think you don't?
I think there's definite inefficiency for sure.
Agreed. So correct answer. So if you're going to pick stocks, you need to own more than this. Unless this is like $7,000 portfolio and we're just talking about like $200 in each one or whatever. But like max weight 15, min weight 2, and like 2% cash or whatever, crypto, fine. Yep, that's fine. But I think you need to get your portfolio construction right and less about the names and more about like how it works for you. And you could take some of that money like out of your ETFs and start doing things a little bit sharper, shall we say, and buy some more stocks or, if you don't want to do global equities, find a global equities manager or two to help you and just outsource that stuff. And then you can just focus on the ASX, or you can just focus on a particular subset of the ASX.
This is, in your view, too consolidated a portfolio.
Too concentrated. And how many stocks would you be looking for in a portfolio? It depends on how many asset classes we're going to cover here, right? So are we just going to invest in Australian shares? Are we going to invest in global? Are we opening up the universe to every stock that's listed on the planet? Well, they're two different. Do you understand what I'm saying? Like the universe, you've got to first define the investable universe that you're living in. And that might just be medtech in developed markets that has revenue. It might be the ASX, or it might be just US equities, or it might be just US equities under a certain market cap. But I think you need to first define where you're going to spend your limited time being good, because that's the part of the market where you should work, and then you should outsource the other parts to really good active managers who are good at those other things that you're not doing, that you want in your portfolio but you don't want to do.
What's your approach at the moment, Tom?
I guess I have heard the advice of, almost the punch card of, you've got sort of 20 key decisions and really not being necessarily too active in the market, which has probably meant that I've held off in terms of if I'm not, high conviction, not wanting to actually make the trade. And I guess to think about the exactly as you say, that, there's so many different things to invest in. There's probably only a few industries which I'd sort of define as, my circle of competence to varying degrees.
Yes, Tom, now we're talking. This is good.
Tried to stay within those. So, for example, resources, I don't really know much about, so I've stayed clear of them, even if it would decrease, I guess, my concentration risk.
Yeah, don't mind it. I think you need the diversification benefits, but you certainly don't need to do that yourself, if that makes sense. Like you can find other people who are good at those things and say, I want exposure to resources, but I want to find a manager who's good at doing resources. Seneca Financial Solutions. Okay, so let's go into something that's more interesting. Let's talk about stocks. You said you're in funds management industry, right? Or you're in investment management? Something.
Yeah,
okay.
Yeah.
Let's talk about Pinnacle. Good business. It's on a free cash flow yield of 2%. Why don't you own GQG? Yeah. Does the same thing. It's on 12% free cash flow yield.
This guy loves GQG.
It's just a good comp, right? It's the same thing to active managers. One is like a single brand active manager with 3 strategies or 4 strategies. The other one's like a multi-shop boutique, but like 10% in free cash flow yield differential seems like a pretty big price to pay for diversification.
So, Tom, have you looked at GQG?
No, can't say I have. But I guess for me, the appeal of Pinnacle is the future growth outlook and particularly how diversified they are. So I don't know if GQG is the same, but with all their affiliates and the outperformance that so many of their affiliates continue to produce, that's the key reasoning behind that one at the moment.
Sure, that's all well and good. But like, what's in the price is the answer to the question, right? So at a 2% free cash flow yield, I can tell you what's in the price and all of that and more.
Yeah.
We can do the same conversation pretty much with Pro Medicus.
I was going to say, we could probably do that same conversation with almost every stock here because, at least in my view, this is a list of high quality stocks, which Luke is going to have angst around the current valuations. Basically all down the list, maybe not ResMed.
Well, Tom, you did mention valuations right at the top. Like, what's your thinking around it at the moment, or question for Luke maybe?
Yeah, I mean, again, talking in general terms, with valuations of equities so high generally, and I'm not adding to my portfolio at the moment because I'm putting everything I can towards my mortgage, I'm sort of watching this become, more and more concentrated and therefore, carry more and more valuation risk because earnings necessarily aren't caught up as of yet. So in general terms, I guess, is there a way in which you can sort of understand where or when, valuation is sort of reached a point where, okay, now, you feel comfortable maybe selling?
I'll give you a tip. 200 times PE is a pretty good price to sell for, right? So, I can only give you a worked example from recent history. You can go back, you can look on Livewire. If you type in my name into Livewire and find Ordinate, we wrote a little paragraph and a bit on Ordinate in a piece that Benny and I put together a while ago. Ordinate was like, I can't remember what the share price was, but it was at the top, $20 a share or whatever. It was high, right? And 2 days later, it had an earnings downgrade and got torched. It was really fortunate timing. We thought it was expensive and blah, blah, blah. And that was our thesis. It was on 100 times earnings and now it's on 50 times earnings and it still looks ridiculous. But the point is that these things don't go forever. And if you took a snapshot of 3 months of media up to that point, all you would have read is people creating various weird and wonderful theses around Ordinate and how it's like the best thing since sliced bread and the blah, blah, blah and the blah, blah, blah. And you wouldn't be able to find a negative word written about Ordinate for the 6 months leading up to that date. So Pro Medicus is a bit the same. And I think there is a lot in the price right now. These things don't last forever. You can be wrong on this stuff for 100 times earnings. I would have said the same thing to you at 100 times, right? So it doesn't mean I'm right. But my view is, would you rebuy Pro Medicus with that amount of money today at today's prices? And if no, then it's obvious sell.
Yeah, and to answer that question, I wouldn't. So
yeah, like you got a tax issue, there's a few personal things that you need to do, but I'd be having to think about that too.
A reminder that Luke has a stock research subscription where he wants to help you cut through the noise with data-driven, actionable investment ideas and insights from the ASX. In other words, he'll send you 2 stock tips a month. It's called Good Research, and we've had a look at it, and I've used it as part of my 500 to 5,000. There's a monthly or an annual subscription. To get 10% off, use the code MATES at the checkout. It's at goodresearch.com.au. Nice. We'll love it, Tom. Thank you for submitting your portfolio. I hope you've got a few things there to think about. And Luke, as always, thank you for putting so much time into thinking about the nickname. I know that's where all your energy usually goes. So,
Tom's got his head screwed on. He's a smart young man. He's doing well. He's doing very, very well.
Luke came in assuming not much. And
he whacked me first sentence.
I think he's left respecting you more. So.
Yeah, you've done well. You're in rarefied air up there, Tom. Rarefied air.
Thanks very much, guys. Appreciate it.
No, that's all right. Thanks for joining us today, Tom.
Thanks, guys.
Small differences in fees could cost you hundreds of thousands of dollars over your investing journey. Here's what you need to know. And Ren, I didn't ever think we'd do it, but we're about to do a segment on fees.
We've definitely done fees before.
That's true. That's true.
Yeah. Look, fees are the one thing you can control when it comes to investing.
Yeah.
There's so much you can't control. What's the market sentiment, what companies are doing, what political leaders are doing.
Yeah.
But the one thing that you can control is how much you pay to get access to the market. And so we've crunched the numbers to give you an idea of just how small differences in fees can add up over time. Because when you're looking at, like, let's say you're looking at a managed fund or an ETF and you're looking at the difference between 25 basis points, 0.25% and 0.5%, it doesn't feel like a lot. But as you said, over the course of an investing lifetime, it really can add up.
Let's use Berkshire Hathaway as an example to kick off, Ren, because Berkshire, love it, they don't actually charge any fees.
And for people who aren't familiar, what is Berkshire?
Berkshire is the investment vehicle of the greatest investor of all time, Warren Buffett.
Nice.
So if you'd invested $200 a month in Berkshire over the past 30 years with zero fees, you would have $554,748.
That's pretty good.
That is pretty good.
That is investing $72,000 and ending up with $550,000.
That is awesome.
Yeah, so you 5x'd your money in 30 years just by investing in one thing regularly and consistently.
That's awesome.
Regularly and consistently is the same thing.
Yes. Now, if that had 0.5% in fees per annum, that $554,000 drops to $494,488. So about $60,000-ish lost just through 0.5% a year. The story gets worse if it's 1%. You then have lost over $100,000. $441,961 is what you would have. Still pretty good growth, but you can see the difference over 30 years. You're worse off to the tune of about $110,000.
Yeah, and that's exactly why we say small differences in fees can compound over time, because it doesn't feel like when you're looking at a fact sheet online and you're saying 0.5% or 1%, it doesn't feel like a lot, but trust us, it is a lot. And, when you're looking at your super funds in Australia or your 401ks in America, those small differences in fees expressed as percentages don't really express how much it could be costing you over time.
Yeah.
So 1% fee is probably out of the norm these days, which is wild to say because it was only, 10, 20 years ago when 2% fees were...
Even 5 years ago when we were just sort of starting out, 1.5% wasn't that wild.
Yeah. So we've taken a look at the S&P 500 to give you a second example. And in this example, we're looking at 0.25% and a 0.5% fee. So this is probably more standard for what you'll see in a lot of ETFs these days. So the S&P 500, the 500 biggest stocks in the US, if you'd invested $200 a month for the last 30 years, so from 1995 to the end of 2024, plenty of things went wrong in the US in that time. They had the dot-com crash, they had 9/11, they had multiple wars, they had the GFC, they had the COVID crash, they had some political upheaval and some congressional calcification. But in that time, if you'd just consistently invested $200 a month, so $72,000 over that time, you would have $468,000.
Okay.
So not quite 5xing your money like Berkshire did, but
not bad.
4.5xing your money.
Yeah.
Still pretty good. If you were charged a 0.25% fee, you would have $444,000. So you would be about $24,000 worse off.
Yeah.
And then if you were charged a 0.5% fee, $421,000. So the difference between a 0.25% fee and a 0.5% fee doesn't look like a lot on paper, but 30 years later, it's $23,000.
Yeah.
And you might think, look, in the scheme of, a $400,000 investment account, it doesn't feel like heaps, but it's $23,000.
Yeah, exactly.
That's,
meaningful.
That's helping your kid buy a house in retirement.
Exactly.
That's buying the round the world plane tickets and going on the big holiday, it's 23 grand. I don't need to convince you that 23 grand's a lot of money.
Yeah, exactly. So I guess what are the lessons here? I think firstly, just like investment returns compound, the impact of fees compound over time. So the numbers are pretty clear. So then it's like, well, how do I make sure that I'm reducing the impact of fees? So check your ETFs and make sure that you are getting the exposure with the least amount of fees as possible. And that's not saying that you flip to the lowest cost ETF if it doesn't match your strategy. It's like within your strategy, make sure you have the lowest cost ETF.
To put like a really clear example to that, every major ETF issuer in Australia has an Australian index tracking ETF, be it VAS from Vanguard, A200 from BetaShares, and IOZ from iShares. Like they're all tracking their market cap weighted, large cap Aussie stocks.
Yeah.
And so the question is, all right, well, they're all going to achieve similar performance. They're all trying to do the same thing. So what can I get the lowest cost?
Yeah,
there?
exactly.
And the good news is they're all incredibly low cost.
So cheap. Secondly is check your superannuation fund, because that's where fees can really creep up. You've got admin fees, you've got all sorts of little fees, kind of not hidden. They're all obviously there, but you just need to make sure that your total gross or net fee at the end of the day is as cheap as it can be, because you're not touching that for a long period of time. So make sure you're paying attention to that.
You say not hidden. They're definitely greyed out.
They're there, but you have to do the work.
Because an ETF or a managed fund has to express their fee clearly as a percentage of total assets, whereas like there are different fees and it's like based on your account balances and some are percentages and some are dollar amounts.
Yeah.
Do the work to check your super and then the fees that you're paying there.
Yeah. And then finally, if you've gone down the route of active management, make sure that you're comfortable with the fee that they are charging. Really, it's like, do they deserve the fee that they're charging?
Are they earning the fee?
Are they earning it?
Yeah,
exactly.
yeah.
Are they beating the benchmark? Are they giving you the returns that warrant a fee?
You're paying for a premium service, so make sure you're getting a premium outcome would be my point.
Exactly.
Yeah.
So I think the moral of the story, check your fees, because it makes a difference. At the end of the day, 23 grand is 23 grand. I wouldn't be saying no to that.
Well, or the Berkshire example was 100 grand.
Exactly.
Yeah. And, 30 years, like some people are going to be investing for more than 30 years. Like if you're in your 20s and you're listening to this today, add at least another 10 years, maybe even more onto that.
Definitely. Anyway, that brings us to the end of today's episode. As always, thank you for listening. If you could leave us a rating and a review in your podcast app now, shouldn't take you more than 2 minutes. We would really appreciate it. It goes a long way to helping us get in front of new community members.
Because we don't charge you fees. We are no fees. All we ask is a simple rating and review.
That's it. Keep an ear for tomorrow's Basis Points episode with Alexander White from Milford. But Ren, we will be back on Monday. So we'll pick it up then.
Sounds good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.